Let me start with one of the most common and most confusing questions almost every NRI has asked at some point. If I sell my mutual funds in India while I'm living abroad, do I need to pay taxes in India and then again in the country where I live in? It's a fair question, and to be honest, most answers that you find online are either too technical or incomplete. So in this video, I want to break it down in the simplest possible way. Let's say you are an NRI investing in Indian mutual funds. Now, when you sell your units, India will obviously tax you first. If it's an equity mutual fund, and you sell it within 1 year of purchasing, then you will pay short-term capital gain tax at 15%. On the other hand, if you sell it after a year, then it's long-term capital gain tax, which is currently taxed at 12.5% on any gains that you make over 1 lakh rupees in a given financial year. And these numbers are as per the latest Feb 2025 budget. Now for debt mutual funds, after the April 2023 changes, things are a bit different. No matter how long you hold, all gains are treated as short-term and taxed at your slab rate in India. So yes, India will tax it first, right at the time of redemption. But here is where it gets tricky. If you're living in a country that taxes global income like the UK, US, Canada or Australia, then you're also expected to declare the same gain in your local tax return abroad. And this is exactly where the big confusion happens. Does that mean you get taxed twice? Short answer is no. You are not taxed twice, but you may end up paying the higher of the two countries' tax rates. India has signed something called as Double Taxation Avoidance Agreement or DTAA with over 90 countries. What DTAA ensures is that the same income is not taxed in full twice. For example, India will tax you first, you then report that same gain in your tax return abroad and then claim credit for whatever you have paid in India. If your resident country's tax is higher, then you just pay the difference. I would just like to add here that I am not a tax advisor or a chartered accountant, so please consult with your CA or your tax advisor before making any decisions. Okay, let's take a real world example. Let's say you live in the UK and you sell your Indian mutual funds with a 5 lakh capital gain after holding it for over 1 year. India charges you 12.5% as long-term capital gain tax, which comes to about 62,500. Now you convert that 5 lakh into GBP and then declare it in your UK tax returns. If your UK capital tax bracket is 20%, then you're supposed to pay 20% in total, but because you've already paid 12.5% tax in India, you will only need to pay the remaining 7.5% to HMRC. That's how DTAA works in practice. You're not paying both fully, you're just topping up to the higher of the two. Same logic applies if you live in the US. You sell your mutual funds in India, pay Indian capital gain tax, and then declare it in your US tax returns. Then you use a form 1116 to claim a foreign tax credit and only pay the remaining tax due if any. Now if you live in a zero tax country like UAE or Saudi Arabia, you only pay taxes in India and that's it. There is no double tax or any foreign reporting headache. Now let's go a bit deeper because this is where the real life scenarios come in. Let's say you are a serious investor and you have been investing in Indian mutual funds through SIPs and you continue investing for next 20 years. You're living abroad right now, let's say in the UK or US, but you plan to return India permanently in the next, let's say 10 to 15 years. So what happens next? So here is how it works. While you're abroad, every time when you sell your units or redeem your mutual funds, you're taxed in India first. Then you declare it again in your foreign tax return and then claim DTAA relief. So yes, there is a compliance headache, but at least you're not getting double taxed. You just need to follow the process. Now, when you eventually return to India and become an Indian resident again, your tax obligation in the UK or US ends. In that case, India becomes your only tax jurisdiction. In fact, for the first few years after you return, will be classified something called as an RNOR. That stands for resident but not ordinarily resident. That RNOR status gives you some continued tax advantages like exemption on foreign income and in many cases permissions to hold NRIFDs tax-free. Once you're fully resident again, all your mutual fund redemptions will be taxed under the normal Indian tax rules and you will no longer have to deal with any UK or US tax reporting. So the idea that you keep paying taxes to the UK or US after returning to India is not entirely true. The moment your tax residency changes, your tax obligations changes too. Now let me share a few practical tips that can save you lakhs and avoid unnecessary stress. First and most important, always know your tax residency status. Every country uses its own rules. Some use the number of days stayed in that country, others look at ties and economic interests. Your tax liability depends entirely on this. Second, use DTAA in the right way. Don't assume you're covered. You need to fill specific forms to claim that credit. In the US, that is form 1116. In the UK, you need to use foreign tax relief in your self-assessment. If you skip this, you might end up paying more than you should. Third, if you're planning to return to India soon, try to time your large mutual fund redemptions in your RNOR window. This helps you to take advantage of tax benefits while they still apply. And fourth, never skip reporting. Even if you pay taxes in India, your country of residence might still expect you to declare that income. Many NRIs have faced penalties and inquiries for not declaring their Indian capital gains abroad, even if they already paid taxes in India. So to wrap this up, no, you are not taxed twice. But depending on where you live, you may pay the higher of the two systems. DTAA helps, but only if you actually follow the process and file correctly. And once you return to India and become Indian resident, you no longer owe anything in your previous country unless you're receiving income in any form like rent or dividends from that country. The key is to understanding how this RRR factor works together. Okay, RRR here stands for residency reporting and redemptions. Because when you get it right, you can save lakhs over the years without doing anything shady or illegal. If this video helped you clear your doubts, please like and subscribe. It helps the channel reach more NRIs like us. Okay, this is all I had in this video. I'll see you soon in another interesting video. Till then, please stay tuned to NRI Wiz. Take good care of yourself. This is Pratik from NRI Wiz. Over and out.